This is Macro Voices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Macro Voices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now, listeners, what we discussed last week was with gold at all-time record highs and having moved up so quickly, we really thought that you ought to be thinking about using option strategies to protect against downside in case there was a sudden pullback in the market. Well, guess what? That was really good advice, but we told you we'd wait till this week to tell you how those strategies work. Hopefully some of you tuned in to Big Picture Trading. Certainly Big Picture Trading members got the full story from Patrick and had time to act on it. For everyone else, Patrick, how do we adjust course to talk about what maybe is a better fit now that we've had this correction and it's already, is it behind us completely or is it just partly behind us? I'm not sure. What do we do from here?
Well, Eric, let's start off actually just talking about gold and silver on the charts and what's happening. And then I really want to take a dive into the way that the options market on gold and silver work. And I find it a really amazing market to trade in. And I want to share with all of our listeners why I feel that way about it. And even though maybe the initial hedge of this correction may have been missed, there's lots of opportunities moving forward to utilizing options on gold and silver and building all sorts of really neat asymmetric trades using them. So on chart 2, I've got gold. And really what I wanted to highlight both on gold and on page 3 silver is that what we witnessed over the span of a several day market correction was a pretty much a 50% retracement of the most recent swing higher. And so this retracement fits all of the typical characteristics of a buy on dip. Usually in the normal ebb and flow of markets, you have a rise and then the rise is checked with a retracement and it's bought. Often you'll have the trailing moving averages sitting just below, which a lot of technicians will be buying the test of moving averages. And what's particularly interesting is gold has had this characteristic going back a year or two that almost all dips tend to be bought within about 5 days off the high. And some are a little bit longer, some shorter. But what I'm very curious about in the coming days is to find out whether this is a dip that was bought no different than every other past one. And if it is, it's an asymmetric moment because often the bases that come off these types of corrections reset the momentum and often put in motion a brand new up leg. And will we see that in gold and silver? That's one of the more interesting puzzle pieces for us to solve in the coming days. But I mean, at this stage, I think giving the benefit of the doubt, I think that this potentially was a key buying opportunity.
Well, I certainly bought more on this dip, and I've got resting limit orders in place to buy even more if we get closer to 1800, which was where the breakout zone started. So I think there's an argument technically to say we could get back down there, although just watching the tape in the last day or so, it looks like maybe this thing's already over. So, you got to buy a little on each dip and be ready to buy a little more if it dips further. Don't rule out the possibility, folks, that there could be even more downside to come.
So Eric, I wanted to move on to page 4, where I have a chart courtesy of Brent over at Spot Gamma. Brent, thanks for sending this over. But what he calculated here was actually the amount of call buying that's happening on silver has put dealers being short gamma on a large amount of call options. And it's showing this chart. It's a very kind of Charlie McElligott kind of chart to look at, but specifically focusing on the SLV options. And what's interesting is that the dealers being short a whole whack of gamma, as the silver is rallying, it's actually forcing dealers to chase the market higher by having to buy the SLV and contributing to the momentum to the upside. A good example of where this was recently seen was when Tesla was ripping to the upside. All the out of the money call buying on Tesla had the dealers short gamma and actually contributed to actually accelerating the upside. And now we're seeing actually a very similar characteristic on SLV. What's interesting is that gamma really gets going all the way up to the $30 strike on the SLV, which still lies $4 or $5 higher from where we are. It'll be really interesting to see with the current structure whether or not some of that volatility gives silver another go on the upside.
Patrick, moving on to page 5, it looks to me like you've designed a ramp to ride a skateboard down to do the gamma flip as you come off the end of the jump. Maybe it's something else. Explain the chart.
All right. Well, what I wanted to really talk about is why I love trading options on gold and silver and why it's such a great market to do all sorts of hedging on. And in order to understand why there's this edge, at least in the character of the way the options markets trade on gold and silver, is to see what a typical options market skew looks like. And what you can observe here, this is the SPY for the S&P 500. You have what's known as the fat left tail, which is as you move to the left side of this chart, the implied volatilities are higher and higher on out of the money puts. And that's typical because the stock market tends to have that nature of that old saying of it rises on an escalator and drops on an elevator. You always have to have a price in a higher implied on the downside risks within the market. And typically, because of this, what it means is that building a zero-cost collar or some other way of hedging risk doesn't allow you the opportunity to do it near zero cost. Often you're collecting a very small call premium for income, and you have a very expensive put to buy as insurance, and it doesn't give you the ability to build asymmetric payoffs. And even though people do it because of the nature of the market, this is just the way that the typical skew looks for majority of stocks. But if we go to page 6 and 7, you can see the skews on both SLV and GLD for gold and silver. And what you can observe is that the characteristic is actually the opposite, where what you have is that the implied volatilities on call options are actually higher as you're going out of the money. And as you go out of the money on puts, the hedging is actually relatively cheaper as measured by the implied volatility priced into these options. And this now gives you a whole array of amazing option strategies that you can implement, particularly to silver and gold, that you don't have the same opportunities to get the same kind of payoff profiles as you would in the traditional market. Now, one of the strategies that I've been doing quite actively, and the one we talked about last week, is the idea of building a collar, which is the idea of buying a protective put and then using an out-of-the-money covered call to pay for it, and being able to do so at a zero cost and have your ability to hedge wrap your risk in there. But what is also really neat about a market that trades this way with their skews is that if you are bullish and you're looking for upside, you can really get some compelling payoff profiles on just very traditional debit spreads or other vertical or even diagonal spreads that you can put on the upside, just because those really far out of the money calls are still paying very robust call premiums, giving all sorts of really amazing option strategies you can build upon it. And so I wanted to share some of these. Obviously, with the gold correction underway, it didn't make a whole lot of sense explaining an existing SLV collar. But what I wanted to do was just share with our listeners, anyone who wants to take a dive into the live markets and see what these kind of trade setups look like. I was going to be doing on Monday, on August 17th, a special live webinar for all of my free trialers and members at Big Picture Trading, where we're going to go into that live market and actually look at these options chains and build all sorts of these really neat different option strategies around gold and silver, taking advantage of these skews.
And that's coming up this Monday, August 17th, 1 to 2 p.m. Eastern Time. You've got to sign up at Big Picture Trading, either for a free trial or be a member at Big Picture Trading in order to participate. Now, if you're not available Monday exactly between 1 and 2 p.m., is it possible to watch it after the fact as a replay?
For sure. The recording is going to be available on the website almost immediately after we do it live. So everyone that wanted to watch it will be able to get access to it. But it's in the live session, I have the opportunity to interact real time with them. And so questions and other that members have, they can throw them at me, and I'm take my very best stab at answering all of the really interesting particulars about using options in gold and silver. But just to give a very quick sample, right now, if you let's say went out on SLV. So let's just say that gamma skew that we talked about on chart 4 stayed true, and there was an opportunity for silver to be bought on dip, and maybe we see an impulse higher that can see us moving toward, let's say, $30 on the upside. Well, right now, if you go out 36 days on a September 18th expiry, doing let's say, $26 to a $30 bull call spread out for 36 days, giving you a $4 upside spread, you can pretty much open it very close to $1. And so you could get a 4-to-1 payoff profile like this for continuing to kind of play the bet that the upside on silver is there and still have a very defined and limited risk if it doesn't materialize. It's just an example of some of the really neat things you can do in that gold and silver market.
And listeners, of course, you can sign up for a free 14-day trial of Big Picture Trading at bigpicturetrading.com.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from bigpicturetrading.com, the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.